Okay. Right. Okay. So you see this topic that we started in the previous session, which is OTC markets versus exchange traded ET markets, which I've also written as forwards versus futures, sort of subtopic, or another name for the same topic, because these forwards are OTC instruments, futures are exchange traded instruments. So one way to understand the difference between these two is to understand the difference between these two. So once you understand the difference here, the difference is basically based on the differences here. So that's why these are related topics. But of course, there are many other instruments which are both ET and OTC based. But these two are clear. These are classic examples because forwards are never ET markets. They are never traded in ET markets. And futures are never traded in OTC markets. These are pure instruments that are only found in ET and only found in OTC markets. Whereas options you could find in both OTC and exchange traded. So that's why you remember that framework that we used earlier, right? So yeah, in this framework, right? In this framework, as you can see, you will see that futures are purely listed as ET markets instruments, and forwards are listed as OTC markets. There's no overlapping here like this one, like swaps. Some swaps are listed in futures markets, although that's not a very good example because this is also, swaps are also mainly a OTC market instrument. But of late, they have started listing them on the exchanges. So the better example is options, which you can have fairly extensive volume in both OTC markets and ET markets. That's why they're listed here. But forwards and futures are purer instruments in that sense. All right, so where we were the other day is we had gone to this file. We are basically, let me just take you back to this document here, which is here. In this itself, you will find a further document. This is what we were looking at. This is this link, okay? This link, if you click this link, you will get this file. And this is what we had, not this actually, we had shown you this, which can be our kind of benchmark for looking at, if we make this 90%, okay, so it's easier to look at this. Okay, so what we had done is we had looked at, we're just using this because you get to see all the differences in one view. And we had looked at the OTC markets, and then we had started to look at exchange traded markets. And we had started out by looking at standardized contract terms. Okay, so we actually, this is the note that we have for exchange traded markets, the second note. And later on, I will put all these notes, the links to all these notes in the consolidated file, which we will use for this course, which will be, we'll just call it forwards versus futures. And that will also cover this versus this. Okay, so let's look at, so we were looking at, these are just the standard prelude to make sure we understand markets. Okay, two assets being exchanged and one asset being exchanged for money. That's the final definition. Okay, so exchange traded markets, I think we'll have to use a shorter to show this nice picture of the NYSE. There's a picture of the NYSE floor, okay? So this is the New York Stock Exchange, which has now renamed itself as NYSE, okay? They have, so it's no longer an acronym. This itself is the name, and it's no longer New York Stock Exchange, just like the NSE. The NSE used to be the National Stock Exchange in Bombay. That has now renamed itself as NSE Limited. It no longer stands for National Stock Exchange. That's because it's no longer just a stock exchange, and it trades all kinds of other instruments. And so to show that versatility or that breadth of coverage, they have dropped the stock exchange element from the name and then just become NYSE. The nice picture you can see of the NYSE floor, I guess when markets are not open, so people are not here. We'll explain all this, what happens here. But the point that we were covering in the previous session is so here. Here, we can move this to the other screen. We don't need it right now. We don't need this also right now. Just okay, so we were covering standardized contract terms, and if you look at where were we? Yeah, so we were looking at standardized contract terms. Yeah, so this is what we were looking at when we kind of finished, and I was pointing you to this. Maybe I should have taken the those are contract specs. So if we actually take it from here, that would be an easy way to understand the standardized contract specs. We can actually take the example of copper, or we can actually take the example of gold as well. We'll show you two, okay? Let's take the example of copper. That'll show you some other things. And then we're trying to show the point about, so we'll come to the other points, but since we wanted to show standardized contract terms, let's use this link here. And so let's open the copper futures. And so we already showed this the other day, but we'll see it once again. And you can see it straight away that there is for copper futures, there's a standardized contract unit. The other day we looked at crude oil, 1,000 barrels of crude oil, not just any amount. Here too, copper is 25,000 pounds. Okay, so you have to only trade in these amounts at integer multiples of, so 50,000, 75,000, etc. So it's a contract size. So straight away you can see all the constraints, trading hours, everything is constrained. Price quotation is also constrained. Then settlement period. Okay, settlement method. This is a very important thing which you will understand later. That when it says settlement method, it either says physical delivery or deliverable. Okay, this means that these contracts, when you can actually deliver, when you sell copper, you can actually deliver it by, you can settle that obligation. Remember, when you sell copper, if you go on an exchange and sell copper, or any kind of general contract where you sell copper, if you're the seller, your contractual obligation is to deliver copper. And since copper generally trades against US dollars, the global copper market trades in US dollar terms. Okay, so the other asset in this market is, in copper, the market is copper versus US dollars, okay, the two assets. And this is, as we said, all markets are always visible as some instrument in the form of some instrument. So this is futures. So this is a US dollar copper versus US dollar futures contracts. That so you're getting the right to own copper if you buy it. You're selling that right if you are selling it. And on the other side, US dollars are flowing from and to the other side. So what happens here is deliverable. Okay, so if you enter into a contract in copper futures, what you're doing, if you're a seller, that means you're undertaking to sell copper, and so therefore you have a contractual obligation on the settlement date to deliver copper. So the point here is that you can deliver that copper with a physical delivery. You don't have, you have the option of delivering it by delivering physical copper. So these are some of the things that are decided by the exchange as part of the contract terms. We'll understand a little bit more about physical delivery as we go further. You guys are also supposed to read the notes, okay? So as I've given you here, maybe this is also a useful thing, so we should keep it nearby. I've given you these all these references, okay? Please make sure you do them, all right? The Halbasu book, So we are still using, although we have come into the IFM course, we are still using the reference from FDRM, but that's okay. You guys have the textbooks, so we can refer to any textbook at any point of time. Okay, so this is one, and I've added one more reference from the previous day, just chapter 8, which deals with the global financial crisis. So please read that also, as well, because it will help you to understand things a little better. So you're supposed to do all these readings. There's no like reading for tonight's session, today's session, or tomorrow's session. These readings you're supposed to do as quickly as possible. Do it, and then we will deal with individual concepts in these readings later on in my own sequence. But you should read it on your own anyway, so that you have a better understanding of what we are talking about. Okay. So here you'll see some, in this also you'll see some references to delivery. So we'll do that. So one of the elements of standardization is that they decide that this is deliverable. Okay. Some of these contracts are not deliverable. Like for instance, let's look at the other contract here. So I want to draw a contrast between this, which is in the case of copper, it says settlement method is deliverable. Let's look at well, S&P 500 futures will not be deliverable. Okay, let's look at what the situation is with. If we go to equity index. Sorry, before I go there, I wanted to show you something important about copper, which is when we talk about deliverable, I want to show you something else, which is when you say what is deliverable, if it's settlement method is deliverable, that means physical delivery is possible, okay, of the underlying commodity. But here, so remember that this is a futures contract, so it's a derivative contract, and there is an underlying price for any derivative contract. And the underlying is basically the cash market copper price, but the copper price for what? So it shows you also as part of the contract terms, it shows you exactly where you have to deliver. Look at this, settlement procedures. I would ask you to read this to get an understanding of how futures contracts work. Open this hyperlink and read it. There are detailed instructions. You don't have to remember these things, okay? You don't have to remember the instructions because you can always click this link and open it up and read it. But the idea is to get a feel for how contract terms are drafted and what kind of issues are addressed, okay? Look at this, grade and quality. You can't just deliver any old copper. You can read these notes, okay? Please read all these notes. This is meant to be an opportunity for you to learn about these things. Here, look at this. Delivery period is standardized, and grade and quality. You can see this. I'll make this a little bit bigger, maybe. And you can see that here, grade 1, electrolytic copper cathodes, okay? It's so highly highly specific as to exactly what you can deliver against this particular contract. You can't just take any copper from somewhere and just deliver it. It has to meet the standards here. So these are some of the aspects of standardization that futures contracts deal with, okay? So you have to understand that. So this is what we mean by standardization, that there is no flexibility on all these terms. So, okay, let's try and look at market data for, and let's try and look at the S&P 500 to see a different kind of okay, let's look at this one. This may be a new contract based on the ESG. We don't really want ESG here. We're not talking about that one. I hope you guys know what ESG is. Do you guys know what ESG is? Does anybody know what ESG is?
Your voice is breaking.
Okay, is it clearer now? Is it clearer
Yes,
now?
sir.
Yeah, okay. So you can watch all this since you guys don't know what ESG is. So this is actually a new kind of theme that people are talking about, although I think there are some problem areas here. This is kind of similar to stakeholder. You heard the debate about shareholders versus stakeholders. This is kind of a little bit like that. I think there are some issues here, but this is you guys should know about this because nowadays everybody's talking about this. So you can watch this webinar. This stands for Environmental Sustainability and Governance. So these are certain standards nowadays that they're asking for. Here you can see environmental, social, and governance. Okay, that companies should look out for these kind of factors when they are running their businesses. Okay, now where is this? Now, this is not what I wanted to talk about, actually, but this is the new contract they have launched to address all these matters. I don't know where these links are, but that's the E-mini. Yeah, that's what I want to talk about. And let's look at the E-mini S&P 500, ES. Let's look at the contract specs. I just wanted to show you something, which is, I want to draw a contrast, okay? So if you see here, I will paste this also into your notes for the moment. And yeah, standardized contract terms. Let's look at this and let's paste this. Okay, this is a E-mini S&P 500. E means electronically traded only. So you don't have this. So there is a CME trading floor as well, okay, which you don't have here. So this is called floor trading. When stuff is trading on the floor, on the exchange trading floor, that's called full floor trading. And there are certain contracts which are not traded on the floor. This is the NYSE floor. I'm talking about the CME right now. But we can show you some interesting pictures of the CME trading floor as well. Well, that's a CBOT floor. How is it? They've changed the picture. Let me try and get a picture of the CME trading floor. We have some nice pictures actually. Okay, so the point is that when you have floor trading, okay, it is an instrument that trading on the floor. But then you have electronic trading because nowadays everybody has, as you can see, even on the floor, it's full of electronic, equipment. So there's a lot of stuff trading electronic. Most of the stuff is trading electronically, although you have the physical floor as well. So when you have floor trading, so E-mini means that this is a mini contract, which is a small contract size. So whatever the S&P 500 index is times $50. So it's a small contract size. And that's why the mini and the E means electronically traded only. This means that this contract does not trade on the floor at all. It's a purely electronically traded contract. This you should understand this contract. This is the most liquid. If you plot this ES, the ticker symbol, it'll be listed somewhere. ES, yeah, CME Globex. Globex is the electronic trading platform for CME. Okay, so the ticker there is ES. If you type ES in your TWS, you can just set up some contracts there for different months. So this is interesting thing to watch because this is the most liquid. This is, although it's a mini contract, it has now overtaken the father contract. Okay, it's overtaken the main S&P 500 contract. It is so popular. It is the most actively traded equity index futures contract in the world. You can trade normal spreads 24/5 on your TWS on this contract. Okay, so this is going to track the S&P 500 index. So the point I wanted to emphasize here, the reason I picked it out, notice the difference between copper and this. Under copper, settlement method is showing as deliverable, okay, which means physical delivery is possible. Whereas in the S&P 500 contract here, it says financially settled, okay, which means that obviously the underlying for this futures contract is the S&P 500 index, okay, because the value of this contract is derived from this index. This is the underlying. This is the derivative product. So it's derived, the value of this contract is derived from the index value, but the index value itself is derived from 500 individual equity securities. But you cannot deliver those 500 equity securities against this futures contract. So if you have sold E-mini S&P 500 futures, you cannot settle them by delivering the underlying stocks. You have to settle them by buying back the short position in the contract. Okay, so that's the difference. So when you learn about sort of the contract specifications on, and basically the point we're trying to understand is, this point, that maybe we can show this nice picture of the floor, but we can use this one. Okay, so the point we're trying to understand is standardized contract terms. And one of the elements of standardization is talking about how you're allowed to settle the positions that you create in these contracts. In the case of copper, if you have a short position, you can settle it by delivering physical copper, but they have also standardized exactly what grade of physical copper you can deliver. But here, in the case of so we'll contrast this with copper once again. We'll open this and we'll show you that in the case of the E-mini S&P 500, the settlement method is financially settled. You cannot deliver the underlying physical asset, which is all the component stocks in the S&P 500 in proportion to the weights in the index. You can't do that. You have to settle it financially, which means buying back or paying the money that represents the value of the contract at that point. So if you're losing a certain amount of money, you pay that money and you settle the contract. You basically buy back the contract if you have sold it and then settle it in that manner. So this is one point I wanted to emphasize. Settlement procedures, again, you can read all these things. When I say read, it's not meant that it's not meant for you to memorize any of these things, but you read it to get a flavor of what kind of stuff the exchanges create conditions on. Okay, so it has position limits, also all these kinds of things, price limits. Okay, so you know that in India, if you're following market commentary in India, which you should also do, following on CNBC or ET Now or whatever, right? So you also notice that sometimes they talk about circuit breakers. It's hit the upper circuit or the lower circuit. Okay, so these are circuit breakers, which are price limits. So if the price moves by more than X% up or down in a particular day, the trading will stop for a few minutes. So these are known as circuit breakers. So these started after the 1987 stock market crash, which you might hear about here and there. In 1987, there was a famous stock market crash. After this, they came out with these kind of price limits, okay, to prevent a big crash. So, so this is the point to understand here, that these are all the elements of standardization. And one of the elements you have to understand importantly is the settlement method can be either physically settled or financially settled, physically deliverable or financially settled. So that's basically this part. So now I think we have a pretty good understanding of standardization. Okay, on ET markets, products are the contract terms are standardized. You have no flexibility. That's strictly speaking not correct. There's some elements of flexibility in certain contracts which we are introducing, but we are talking about the classical distinction. For most of the contracts, this is the state of affairs, that it is highly standardized and very limited flexibility. Okay, we'll talk about flex options and certain types of products where the distinction is getting blurred, but we'll come to that later. First, let's understand the pure classical distinction as it existed about 20 years ago or 30 years ago. And then we look at the nuances in terms of how they are changing a little. The distinctions are getting blurred a little bit in the modern age after the financial crisis. Okay, so that's one. Now this second part is the counterparty credit risk managed by the exchange. Okay, let me explain how this works. So here you can refer to this. So OTC markets, as I showed you, okay, OTC markets, another example, better example is this, which we showed you here. Now OTC markets are like this. All right, forget the right-hand panel, forget this. The OTC markets are like this. So they're all trading with each other and they're taking the credit risk of each of the other parties, okay? So everybody's taking the other guy's credit risk. And if one of the guys goes bust, the other guy is left holding the baby. So there is nothing they can do about it. They can sue them and then they'll take a long time to recover the proceeds through the court process. But so what we have tried to do is show this in the OTC market world in this kind of a framework. Okay, so you have, I have listed everybody as a clearing member. You'll see why. Okay, you can think of these as individual participants as well. You can think of these as customers. So this could be a company, maybe you can think of a company, any company. Let's say this is Airtel, and this could be a bank. This could be Standard Chartered. So Airtel could be dealing with Standard Chartered in the OTC markets, and each of the counterparties is taking the other guy's credit risk, okay? So Standard Chartered will have certain credit limits and set up for, they just can't start trading with each other because they need to have credit limits set up for each other because they're going to be taking credit risk. So Standard Chartered would, before they start trading on, if any of you join a bank treasury, you will face this. Like one of your seniors now is he had joined a rating company after campus, and he's now actually working with Standard Chartered as a ratings guy. So one of the things, he is a credit analyst. So one of the things he would be doing is, if he's assigned to the Treasury department, one of the things they will do is the Treasury guys want to do business with Airtel. So the bank treasury guys want to do business with Airtel. So what they'll do is they'll get the financials of Airtel and ask their credit team to the treasury credit analysis guys to set up a limit for Airtel. So that maybe $20 million, $30 million worth of trading can be done, okay, with Airtel. So they'll set up a limit. They'll look at the financial statements, analyze those, and set up some credit limits. And then based on those credit limits, Airtel can then call Standard Chartered for prices in foreign exchange or interest rate swaps or this and that, okay, various types of instruments. And that's how they deal with each other. So they're still taking credit risk, but they have done some analysis of the financial statements, and they have come to the conclusion that, okay, I think we can take a reasonable risk on Airtel for $50 million up to 6 months or up to, and these limits have two dimensions, okay? So the credit limits have two dimensions, which is that if we write this here in the OTC markets, we're going back a little bit, back and forth a little bit in these notes. I'll talk about credit risk managed here. Okay, so we can talk about here. So what happens is, so we can say this, that counterparties, what they do is, the point to understand is that these limits will have two, let's put it not just two, but multiple dimensions. The limit has multiple dimensions. Okay, so when we take this example of Standard Chartered setting up credit limits for Airtel, okay, multiple dimensions. Okay, so what are the multiple dimensions? It could obviously the most important thing is amount, that you cannot trade with Airtel more than for any amount greater than 50 million. That's one amount. Tenor is one more. Okay, you cannot do any deal with Airtel which exceeds, remember forward contracts? I talked about forward contracts. I showed you forward contracts earlier. Okay, so forward contracts will show you how long, how far out the, so if you look at this, so we just take, as we said, futures are very similar to forwards. So if you look at copper futures, we can use this as a proxy for forward contracts. Okay. They're very similar to each other. You can see how far out they go. All right. Okay, so copper is not as liquid as crude oil. It doesn't go out as that far out. But maybe you can see. Let's assume that there is trading volume all the way here. It can go all the way here. But when you're setting up a credit limit in the OTC market for a counterparty, you might say that, okay, at this point of time, you can't trade more than 1 year out. Okay, so max you can do a deal with Airtel is up to December 2021. Okay, you can't trade up to more than a year. So the deal is, so the point I'm trying to illustrate is that when you are setting up credit list limits for each other, they have several dimensions, multiple dimensions. One is amount, one is tenor. Okay, so you will say that we can't trade with Airtel for a period longer than 1 year, because you can actually have much longer transactions. Okay, in terms of forward contracts and their maturities, you can have very long contracts. In foreign exchange markets, you can actually have 20-year forward contracts. So here you would set some kind of limit for each customer. So maybe the blue chip customer like IBM, you will have longer tenors in terms of limits. But if it's a very small company just being set up, then you would not give them long tenors because you're not so confident about their credit quality. So it will have amount, tenor, it will have instruments, okay, eligible instruments. So you will say that I can trade in, forward contracts, option contracts, swap contracts, or you may leave out some of those contracts, etc. Okay, so the point to understand about limits. So the first thing to understand is when we say counterparty credit risk is managed directly by the counterparties between themselves. So it's not just they just blindly trade with each other. Party A can just call up party C, and party C has never heard of party A, and then they say, okay, let's do a deal. It doesn't work like that. If you want to deal with if these two parties want to have a trading relationship in the OTC markets, what they have to do is they have to get in touch with each other, exchange financial statements, okay, and their credit risk teams in these two banks or institutions will set up credit limits for each other, and those limits will have certain dimensions, as I said. What is the amount that you can have trading? What is the tenor outstanding? Okay, what are the eligible instruments, etc. And under amount, there will be another thing. So you're trying to understand now. You're learning a little bit about this. Will be very useful if anybody joins a bank or an investment bank in anything to do with trading, credit risk, or even if you join a corporate bank, you will understand these limits. Like some of your seniors are working in HDFC. I know that they're working in HDFC corporate bank, a couple of them. They are actually doing classical corporate banking work, which is they're acting as a corporate bank relationship manager, which means they're going to various companies and trying to sell the various products that HDFC Bank has to those companies. Okay? And so some of the products they will sell are treasury products, so forward contracts and derivative contracts like swaps, options, etc. So when they set up amount limits for each other, there are two elements to that. You have to understand that as well. Okay, one is the yes, somebody has okay. All right, so under amount, you have to understand two elements. Okay, Okay, so let's keep it here. So this is basically, you have to understand outright, now we should not call it outright position limits. We should call it total position limits. Uh, okay, let's use the word position. Total position limits and so we'll discuss this a little bit later, but the point to understand that there will be two types of limits. Okay. So, okay. Now, what does this mean? Total position limit and daily settlement limit. Let me clarify this. So these are all nuances of credit risk management between OTC counterparties. Total position limit and daily settlement limits. Okay. Total position outstanding. Okay. Outstanding doesn't mean exceptional here. It means how much is open, okay, and not closed out. Total position. So let's give an example. Okay. This may be, let's say, 100 million. Okay, so in the foreign exchange terminology, we say this could be for any kind of asset class. I'm just using the FX terminology. So 100 million could be your port. So Standard Chartered might have a 100 million trading limit with Airtel in terms of amount, but amount has two aspects to it. The total position limit. So at any point of time, Standard Chartered Treasury can have $100 million worth of contracts outstanding with Airtel. Okay. Lots of forward contracts, swap contracts, forward contracts, swap contracts, forward contracts, option contracts. Credit exposure outstanding could be 100 million. Okay, in terms of deal size. Okay, and then you could also have the settlement, the daily settlement limit, and the daily settlement limit will be usually smaller than that. Okay, so that will be something like maybe 10 million. Now, what that means is, remember that when we had this point about, we keep talking about transactions are contracts to exchange assets, because a financial market is a venue for exchanging assets. And we have fine-tuned it because in most markets, one of the assets is some kind of currency, either yen or dollars or Swiss francs or something. So we have fine-tuned it as a market is a place where you exchange some asset for some currency, okay? And the currency is also a species of asset, so we can refer to it as an asset. So market is a place where you exchange assets. So when you do a transaction in a financial market, it's actually a contract to exchange assets. And then you have to deliver the contract, okay? So you have to deliver, you have to fulfill your contractual obligations. So each party has to deliver the particular contract that they have sold, okay? Particular asset that they have sold. And the date on which that delivery happens, okay, that's called the settlement dates, okay? That's the settlement date. And the transaction date is when you finalize the terms of the contract and lock into the contractual obligations. So there can be a very big difference between these two. Okay, as you can see here, we may have actually closed, we may have taken this out, but we have shown you here that the settlement date in the case of cash, value cash instruments, okay, value cash transactions, there is no difference between the transaction date and the settlement date. So the T plus X is the settlement date. But in the case of forwards, as I told you, you can have even 20-year forwards. In the futures contracts as well, as you saw, in the case of crude oil yesterday, you can have futures contracts running very, very far out into the future. So those will be the final settlement dates for those contracts. So there can be a very big gap. Okay, so when we are talking about this, coming back to this, so you have a transaction date and a settlement date, and the two can be very, very different in terms of the distance between them. Right, now, as you can see here, you can have a contract maturing in March 2022, which is you would enter into today, but the final settlement will happen at this point of time. So what we're talking about here, when we talk about credit limits, is the daily settlement limit, okay, which will be, so daily settlement means that I'm allowing you to do a total of $100 million worth of transactions with Airtel. Okay, so you could do several transactions. You could do a forward contract for 6 months for maybe 15 million. You could do a swap contract for maybe whatever. I mean, we have not given the time limit. Let's say we have not specified that. Remember, they'll have a time limit as well. Tenor will also be fixed. You can't do deals longer than 2 years with Airtel. There'll be some kind of fixed limit, some kind of rule like that when the limit is sanctioned. So you can do maybe a swap contract for 35 million, etc. But the point is that the second rule you have to follow is you cannot have more than 10 million coming up for settlement on a particular day. Okay, so that's why you have a daily settlement limit. You'll have a total position limit also. So this will be bigger than this. So you got to understand these elements. These are this is how you operate in the real world and manage your counterparty credit risk in OTC markets, right? So these are all elements which I'm just giving you a flavor for, because you get the understanding of how detailed things are in the real world. And you also get this conceptual understanding of why you have these two differences, so that if there is any default, the idea here is that if there's any default on a particular day, okay, this is how you deal with that, and then you make sure that you don't lose more than 10 million. Okay, so you don't have the entire 100 million maturing in one day. You limit your daily settlement exposure. So if there's any problem with Airtel, then on a particular day you can only lose 10 million. Because your settlement limit is 10 million. So this is something you should understand. Okay, so we go back to exchange. So this is the idea of how did we come into this standardization. Okay, so somehow from here we moved into this, but I was explaining the different kinds of settlement. Okay, the ways to settle the contract. Okay, so I don't know how we got into this, but anyway, it's a useful discussion because you need to understand how limits are being set in the OTC markets to manage credit risk. Okay, so let's come back to, so I think I was about to get, the reason I came into that was, I was about to get into the discussion of how these guys are taking, I was coming to the exchange traded markets. Before that, I wanted to show the contrast with OTC and how credit risk is managed by these guys. They have to analyze each other's credit. So this system can be quite cumbersome, okay? So every time you want to trade with somebody, you got to go and analyze their financials, set up some limits. It can be quite complicated. So here we have a solution in ET markets. We have a way for you to remove that risk, okay? So maybe here I should make this even smaller. Yeah, so you see the same thing there, okay? So I don't know if you guys can read this. Can you read this? Retail institutional customer 1.
Yes, sir.
You can read it? Okay, introducing non-clearing broker, that's fine. Okay, so I was trying to show you those pictures on okay, so they're closing some of these floors. Right now they're closing, they still have some floors, but that's actually because of the COVID problem now. But other floors, the floor closings that I was talking about, is those are actually based on this is actually, let me just copy this. Let me copy this image and put it here. It's a nice picture. So under exchange traded markets, since you've got this nice picture of the NYSE trading floor, let me put another picture here of the CME trading floor. This is probably the S&P 500 pit. These are also called trading pits, okay? Probably CME, S&P 500 trading pit, okay? So this was the main S&P 500 trading pit. This is also called a pit, okay? It's called a pit because there's a hollow part in the middle, okay, where people used to trade. So that's why you have pit, okay? Maybe here they have a, yeah, so these are also examples of the trading pit. And this is now different, okay. So anyway, so here's I just want to show you this because this is part of the kind of a folklore of trading. And they still have some of the pits today. They just recently closed. They're closing and opening because of the COVID problem. So some of these pits, you can see what's happening in a physical place where they're all gathered together and they're trading with each other. Now the advantage here is that everybody on this floor, okay, everybody over here is somehow connected to a clearing member, okay, and they're connected to the clearing house. So they're not going to have to set up separate trading limits every time you want to trade with each other. You know that everybody is connected to some kind of clearing member, and the clearing member is connected to the clearing house. So we'll explain how this works. So this is the mechanism for managing credit risk. So you will read about it you can read about it in the book also. If you look at your book and you see how they work, you can read a little bit about all these the differences, and then you have chapter 2 as well, which is this is chapter 1. You can look at chapter 2 as well, which is where we have where are we given the page number? So it's page 23. If you go to look at 23, you can read a little bit about how these things work, futures markets. So central counterparty is a term that is used in OTC markets that actually should not have been discussed in the introductory chapter. But you can see here, we're here talking about physical delivery, like we showed you in copper. One of the things that can happen with physical delivery, this is in the case of live cattle futures. So you should read all this stuff to get a flavor of things. Okay, and specification of a futures contract. And then you have delivery arrangements, delivery months, and yeah. So here you can read about this, how it will happen. Then you have clearing members that they've talked about. So read all this stuff, okay? We'll come to this daily settlement business. But the point here, let's understand the schema from the chart that I've given you here. You'll find it in this sheet. So understand how this works. So we are going to get away from this messy situation in OTC markets where every time I want to trade with somebody, I have to get hold of their financial statements and analyze their statements and set up credit limits. And those credit limits are going to have all these dimensions like total amount, position limit, settlement limit, what is the tenor, what are the eligible instruments. It's a big headache. I don't want to be doing all this every time. So let me go and trade on an exchange. How does the exchange work? Let's understand it this way. So the exchange clearing house, okay, I have talked a little bit about the exchange clearing house later on here when we talk about counterparty credit risk managed by the clearing house. Okay, so we'll make some statements here which may not be 100% clear at this stage, but we will explain them down the line. Okay, down the road we'll explain them. So let's look at this. So this sheet, ET markets, this will take you to this will take you here. If you click this, it will take you here to this particular sheet. Okay, so let me explain here what is going on. Right, so this part which I've mentioned here, you can read about this. The exchange clearing house and the exchange, E is for exchange and ECH is for exchange clearing house. They can actually be different entities, and when we understand the concept, we should understand them as separate entities, but they actually work very close to, closely with each other. So we will, in the diagram, I have given the exchange clearing house and the exchange. So this trading is happening on the exchange, okay? Like this kind of an exchange. It's happening on the exchange where you have floors, trading floor like the CME S&P 500 futures pit, or you have the NYSE floor trading. These are both exchanges. So this was mainly trading spot equities, this exchange, mainly trading spot equities, but it's an exchange traded environment. And this is trading equity index futures, S&P 500 futures trading pit. This is trading S&P 500 futures. And I think the options rate is different. This is just the main futures trading pit. And nearby, you will have the options on this particular futures contract, the massive contract. Okay, so you can read some of the books which I've shared with you in the finance reference called Market Wizards and all these books. These are very important lessons. There are many, very important lessons for trading, risk management, etc. And there you'll see lots of discussion about the trading pits in Chicago. And so this is basically it. Now this is happening here, okay? On this, so this is an exchange which is managing the whole trading activity. They are hosting the floor, etc. And then they also have a clearinghouse that they are connected to. Either it's an integral part of the exchange, or it is a separate clearinghouse. They have an arrangement with the clearinghouse. So we have discussed it together as exchange clearinghouse, as if it is in-house, housed within the exchange. So this is how it works. So you have a retail institutional customer. Now this could be, say, let's talk about a retail customer to understand properly, okay? So since Vipul is trading actively, so let's put Vipul as a customer. So Vipul is our customer. Now I'm giving you the stylized schema, okay? In practice, some of these elements may be missing, or they may get merged together, okay? Just like we talked about the exchange itself, okay, which is providing the trading facilities, okay, and the venue and standardizing all the contracts, coming out with all these contract methods. These are all being done by the exchange. The clearinghouse has a very specific function, and they may be, so economically, we should think of it as a separate function, okay? But they have to work very closely with the exchange. So we are talking about the exchange clearinghouse. This may or may not be owned by the exchange, but it's the one that is connected to this exchange, which clears the trades that are happening on this exchange. So Vipul wants to do a transaction in S&P 500 futures. So he goes through an introducing broker. Maybe his introducing broker is, say, Sher Khan, okay? And Sher Khan has a connection to a clearing member, which is connected to the CME group, okay? So the clearing member will be, let's say, IB, Interactive Brokers. So here, let's see, this is, these are all 11 size. Okay, we could maybe make it a little bigger. What happens if we have it a little bigger? If we make it like 14, yeah, we can still see stuff, okay? So Vipul is the retail customer. Now this could be an institutional customer as well. So we can replace Vipul with, let's say, a company. We can replace them with, say, we can replace him also with a company like, say, Nestle India. Nestle India might want to do a trade, okay? So instead of Vipul, we could have Nestle India. So retail institutional customer that wants to do a trade. Then you have the introducing broker. Okay, so one of the things that happens if I increase the size is that this thing goes out. Here we can make this a little bigger. So the term is introducing broker, okay, which is a non-clearing member. So the reason I write non-clearing broker, non-clearing member broker, actually it should be non-clearing member broker. So non-clearing, and because clearing member has a particular status, so we'll understand that. Okay, so let's understand here what we mean. By introducing broker, we mean that it's not a clearing member. Okay, so non-clearing. Introducing broker, so Vipul goes through Sher Khan. Sher Khan calls him up and says, Vipul, do you want to trade? And Vipul says, yes. Okay, then Sher Khan is not itself a clearing member on the CME. So they have a tie-up with IB, and then you have the CME clearinghouse. Okay, so this is the exchange clearinghouse, so which is CME clearing. Right. So you have this. Now, what happens is, all right, Okay, so what happens? This is how the trade flows. So when they set up the account, now Vipul will have to deposit some initial money, maybe $2,000. And so that money Vipul gives to SK, and they sign a contract, okay, for services, and the minimum account opening balance. So he sends the money. The money goes, $2,000 goes from him. It goes as directly as a check deposit to or interbank clearing deposit to Interactive Broker's account. Okay, so Interactive Broker will then open an account in the name of Vipul Garg, but it will show that Interactive Brokers will show first that it's a ShareCon account, and they will deposit that money again with in this case, they will deposit money with, they'll keep the money with themselves, but when a trade happens, they'll put the money to CME clearing, but they'll keep the money with themselves, but they'll mark the account as both ShareCon and Vipul Garg. Okay, so it will know, they will know, because IB is dealing with many other entities like ShareCon. So they need to identify, so they will know that Vipul is a ShareCon customer, and so they'll have an account in the name of Vipul Garg, stroke ShareCon. Okay, so this is how it works. And now when Vipul has to do a trade, you will see here there is a mention about initial margin. I'm just referring to certain parts of the whole book. Okay, so when you do a trade, you will there's certain contract size, and then there's something called initial margin. Okay, the trader has to here, if you see, because when it is the contract size, based on the contract, the broker will require the trader to deposit funds in the margin account. Okay, so this is known as a margin account, because in the case of futures, it's called a margin account, because you put up some money on margin and then you borrow the rest of the funds. You can borrow the rest of the funds to make up to allow you to trade in the products. It's called a margin account, wherever you're allowed to do some borrowing. So you buy stuff worth $100, but you put up only about $10 from your side, and the rest you borrow, $90 you borrow from the broker. So that's why it's called a margin account, because you are able to put up margin and borrow the rest. So okay, so they have this system set up. Now what happens is, when Vipul wants to do a trade in gold futures, okay, he will put up what is called initial margin. So this will be specified by the exchange, how much this is going to be. Okay, so he will the exchanges here, in this case, they have talked about 6,000 per contract. Okay, so if he wants to do 2 contracts, he has to put up 12,000. So initial account opening balance is $2,000, but if he wants to trade in gold futures, he will have to put up initial margin just to do the trade. Okay, just to be allowed to do the trade, he'll have to put up the initial margin, which is $12,000. In this case, 2 contracts, so 6,000 per contract. Okay, now what happens is, this money, now we can see the flow is a little bit different. Okay, so Vipul has to now ensure that his account with IB is funded via ShareCon. Okay, well, via means money doesn't go via ShareCon, but actually the marking, IB is marking it as a ShareCon account. They will be asking ShareCon for the money. Okay, so they'll be asking ShareCon, and ShareCon will inform Vipul that he has to put up $6,000 so per contract. So he puts up the money goes into IB's account, and IB, in order to do the trade, in order to have the trade cleared through the CME clearinghouse, IB must show, in order to register the trade as a valid transaction, IB must show that $6,000 per contract was put up, and they must send that money now to the clearing account. Okay, so the status of a clearing member comes from basically having accounts with the exchange clearinghouse. Okay, every clearing member has an account with the exchange clearinghouse. You can think of this system as very similar to the central banking system that you have in most modern economies. Okay, so you would have, in the central banking system here, you would have the central bank, like the Reserve Bank of India or the Federal Reserve. Okay, so the Reserve Bank of India is a central clearinghouse, and the people who have accounts with the Reserve Bank are not individuals or even companies. Okay, so like Microsoft India can't have an account with the Reserve Bank of India. Microsoft India has to go through a what we call a scheduled bank, which has an account with the Reserve Bank. So therefore, it's a similar kind of system. Okay, so we can't open directly accounts with the Reserve Bank of India. Similarly, you can't open direct accounts with the clearinghouse. Usually, you go through these chain of brokers. So you have clearing members. The status of the clearing member comes from having an account at the clearinghouse where these guys will put some minimum balance requirements on these guys. Okay, so you have to have certain minimum balances, and on top of the minimum balances, maybe let's say the minimum balance is say $50 million. So so Interactive Brokers, being a clearing member, must always maintain $50 million with the exchange clearinghouse. I'm just throwing out a number. I don't know what the actual number is. There'll be some number. Okay, so Interactive Brokers has to maintain a minimum $50 million balance with CME clearing. On top of that 50 million, every time a customer wants to do a trade, they will look at this initial margin, and that initial margin also has to go from IB to CME clearing. So if Vipul is doing 2 contracts, 6,000 into $12,000 has to be deposited into CME clearing every time in order to allow the trade to go through. Okay, so then he has a valid transaction. That's how the system works. Okay, so that's what I've tried to show you here so that you can understand it later on. Exchange traded market. I have sent you to the sheet here, how it works, trade settlement. How is counterparty credit risk being managed by the clearinghouse? Okay, so you can read about all this, margin amounts, contract specs, standardization. We've talked about all that. Okay, how does the trade settlement happen through the exchange? That's what we're trying to understand. So you need to understand the sequence. So here I've called it, so in this case, Vipul is the tick, trade initiating customer, tick. Okay, and then you have the non-clearing member. It's easier to see this in a visual sense. Okay, I've just written it here, and all this stuff I just told you is all this written. All this stuff is already explained visually. Okay, this is how it flows. Right now, if you read, so you read all this in conjunction with your book as well. Okay, you read my notes as the first reading, and then as the overall structure, and then you refer to these. You also do the reading in the book, the chapters I've told you to read, and then you'll get a complete picture, and you can keep referring to it, my notes as well. And then if you have any doubts, you can always ask me. Okay, so here let's look at something else. This initial margin. How does this So basically, the idea here in ET markets is that we are going to remove this risk. So here, what is happening is, say, Vipul is actually normally trading with some other guy on the other side. Okay, maybe on the other side there's some other guy who is trading. Okay, maybe Utsav is trading on the other side. Okay. So now Utsav doesn't know Vipul, and he doesn't, and vice versa. So what they want to do is, they don't want to be bothered with taking credit, analyzing each other's credit risk. They just trade on an exchange. So then Utsav doesn't have to worry about whether Vipul will pay or not. He only has to worry about whether CME clearing is going to pay. So the transaction will happen. There will be 2 transactions, as we showed you earlier, that in the case of we use the OTC market central counterparty system to show you that. Although this is not really, we don't really use this term for ET markets, but I'm just showing you because it's convenient to show the scheme. Okay, it's the same kind of thing that you can see here as well. I think it's better to use this. If we use a smaller zoom, you can see everything together. So here you have the 2 customers, and they're trading now. Instead of having one, in the case of OTC market, there will be 1 contract between the 2 customers. Now you have two contracts, customers trading with CME clearing, and here the other guy is also trading with CME clearing. Okay, these things are all clarified in the Hull book as well when you read it. Okay, so you'll see that he talks about how each of the traders is actually trading with the exchange. There are 2 contracts. Okay, so this is how it works. Okay, so so the idea here is for the clearinghouse to step in the middle, step in between, and manage the credit risk. So now we need to understand how exactly the clearinghouse manages the credit risk. Okay, so that is all mentioned here in daily settlement. Okay, and so there are some statements you'll find here. Let me make a comment about a couple of statements that we have here. as before we go on with our discussion. I think I've mentioned it here. Yeah, okay. Let me make a statement here. Later on, I'll integrate it into the futures discussion. This is today's class 1-1. Are we underlining that? Yeah, we're supposed to underline that, right? So we can understand, and underline and bold, so we can understand the breaks in the what we are discussing on a particular day, and underline and bold. And we are here today, 1st of Jan. All right, okay. So I want to just talk about a couple of things here before we go on. That is, what was I saying? Daily settlement. Okay, now you see that in 2.4, he talks about, this is 2.4. Yeah, this is 2.4 in Hull. Operation of margin account. So there's some statements here that I want to talk about a little bit. And here also that you'll see a statement which says, let me first talk about, yeah, this is, let me just find the statement in the, towards the end, they actually make a statement that yeah, look at this statement here. Okay, this statement is happening on which page? It's very hard to read the page. This is on page 31, okay? Where is this? Page 31, okay, there's a statement here. I want to talk about the statement briefly, okay? Yeah. Whereas a forward contract is settled at the end of its life, and page 31. I want to make this comment about this statement. Page 31 is Hull Basu, okay? Yeah, but this is not a very good statement to make, actually. This, I have a problem with this kind of, a futures contract is not being settled daily. Actually, what is happening, the correct way to write this would be, the correct drafting would have been, that, where it is, because we want to be very particular about how we use words, okay? When you have settlement, because we use a term like settlement, so settled daily means you have already settled it. So this question of daily settlement doesn't arise, although even here you see that earlier he has got a particular module starting, just like further details starting, called daily settlement, okay? Yeah, daily settlement, yes, but of what the contract is not settled daily, this statement is not correct, okay? If futures contract is not settled daily, what has happened is, whereas a forward contract, actually what should be written is that you'll understand what I'm talking about, okay? You can't have gains and losses together. Gains, losses on a forward contract. We won't worry about, so grammar, it should be are settled, but we'll just keep it as, forget the grammar. I'm not trying to make a point here about what should be included in the sentence, okay? It's the gains and losses on a forward contract that are settled, okay? And the contract itself, okay, is settled at the end of its life. When the contract itself is also said to be settled. Okay, so this is the settlement date. Okay, So in the case of a forward contract, you have one transaction date and you have one settlement date. Okay, so that actually should be referred to as the final settlement date. Okay, contract itself is also said to be finally settled. Okay, in the sense that the contractual obligation to deliver the assets that each party has sold is discharged. Hopefully everything goes smoothly, nobody defaults, and then you have a final settlement on the settlement date. Okay, so we can say that the forward contract is finally settled. Okay, the contract. So I'm making a difference here. Notice I'm making a distinction between the contract itself, the settlement of the contract itself, and the settlement of gains and losses on the contract. Okay, these are two distinct things, and I think when we write, we should be very particular, because maybe everybody's not that particular about the use of language, but I think it's important. So we should analyze this statement in the book and say the statement is not correctly drafted. The correct drafting should have been that gains and losses on a forward contract are settled, and should be are, but I'm just forgetting the grammar right now, are settled at the end of its life. Okay, when the contract itself is also said to be finally settled. This is how it should be worded. Gains and losses on a futures contract, gains, losses are, let's clean up the grammar here as well. Gains, losses on a futures contract are, as we have seen, settled daily. Okay. Gains, losses on a futures contract, as we have seen, settled daily. Okay, so what we're trying to say is, when will it be finally settled, the futures contract? Well, let's look at it. E-mini is not a good example, because the financially settled contract, so it doesn't have too many months trading. Usually, you'll notice another thing that you can learn about right now in this. You'll notice that those contracts which are financially settled, okay, and physical delivery is not allowed, they usually will not have, like crude oil, copper, all these several months trading. They will usually have only 1 or 2 months trading, because these kinds of situations happen when you have people who are physically involved in the copper trade, who want to hedge for long periods, and they lead to the activity in these long-term contracts. So in the contract, you'll notice this pattern about in the futures markets, in commodity futures, where you have certain futures contracts where you can have physical settlement, that is physical delivery for settling the obligations. These will have many contract months trading. But in the financial futures contracts, if you go to the E-mini and you look at the quotes, you will not see that many months trading together. Okay, you'll see, because this is the financial contract, so mainly the activity will be concentrated in the front month. Okay, mainly all will be in the front month, and maybe you'll have 2-3 months. You see this? You don't have that many months trading. Okay, that's because there's no real physical settlement involved, so people are not really involved. And you see all the heavy concentration is in the front month. There's another little bit of it in the second month, but most of the concentration of volume is in the front month. So you'll not see this pattern with commodity futures contracts where physical delivery is allowed. You'll see a much more even distribution of volume across the contract months. Okay, so let's talk about this now. When you talk about when is the contract finally settled, this is, again, since we are talking about long-term contracts, let's talk about the copper contract. Let's go back to the contract specs. Okay, what do they have to say about termination of trading? Look at this. Termination of trading terminates 12 noon CT, means Central Time, Chicago time, On the Chicago is 1 hour behind New York. Okay, New York is Eastern Standard Time, and CT is Central Time. Okay, on the third last business day of the contract month. Okay, this TAM is trading at market. Okay, so we don't have to worry about this. So trading terminates at 12 noon Central Time on the third last business day of the contract month. So which means we go to, say, suppose the contract month is, say, March 2022, then find out the third last business day of March 2022. 12 noon on that day, that's when trading terminates. Okay, so let's borrow this phrase from here. Okay, and write it here. Okay, this will not transfer very smoothly, but we'll take care of that later. Where was I? Okay, I was talking about this here actually. I was talking about the improper language. Okay. Well, okay. Have you understood what I'm trying to say? This is really relating to the very careful use of the English language, which I think is important because this can help you to clarify your concepts or even prevent you from having the wrong conceptual understanding. So I want to make a very fine distinction, which they have not made in the book, okay, between the settlement of gains and losses on a particular contract, whether forward or futures, versus the settlement of the contract itself. Okay, so because the settlement of the gains and losses is actually it can differ. The manner in which it is done can differ based on how the credit risk is being managed. Okay, how exactly it's being managed, the counterparty credit risk. But the settlement of the contract itself is a different matter. It's a matter of contract law where you discharge your obligations under the contract. Okay, so the final settlement happens when the trading terminates on that contract per the exchange rules. Okay, so I hope everybody has understood what I'm trying to say here. It's a very fine point where I'm critiquing something written in the book because I think it's important to make this distinction, because in the way you speak, is connected to the way you think. So if you're not speaking in a highly fine-tuned and precise manner, that means you're also not thinking in a precise manner, and that can create problems for what kind of outcomes you experience as well. So you're very important to be speaking correctly, using the language in a highly precise manner. Okay, so small point of distinction: gains and losses are settled daily, but the contract itself is settled, okay, when the trading terminates per exchange rules. Okay, that's why I'm saying this statement is not correct. To say that a futures contract is settled daily, that is not a correct statement. The futures contract is finally settled only once. It is the gains and losses on the contract that are settled daily. So this fine distinction should have been made. That's the first point I want to make. The second point I want to make, this is what happens when, the second point you'll see when, again, this is basically what happens when people are not that particular about the use of the words, how language is being used, which I think is important to do actually. Let's try to go back to the first part here. This is on page 28, okay? Okay, so under this, now let me just extract this also. I think it is page 28. It keeps jumping actually when it should be page 28, no. Or maybe it's page 29 or whatever it is, operational margin accounts. Page 29, okay? So the other point I want to make under session notes, yeah, let me make this point over here. This is a quote from the book. Okay. Both of these comments that I'm making are connected to the idea of being very particular in the use of words, which I think is important for anybody, not just in finance, but in any aspect of business. This is not a time when you're going out, hanging out with your buddies at the Cineplex weekend. Then you don't have to be particular about the use of words. But when you're talking about anything to do with the use with the world of business, you have to talk like a computer. You have to train your mind to talk and think like a computer. If you talk like a computer, that means you're thinking like a computer, which is the way we want you to be trained. Okay, so it's actually not 100 ounces, it's 100 troy ounces. Okay, so please note, if you go to gold, and click, there is a difference between a troy ounce and an ounce, which I have given you the link here. You can read it. There's a difference, about 10% difference, but still 10% is a big deal in financial markets. So we must be very careful about how we use word. We should not say ounce when it is troy ounce. Okay, ounce is when your mother's baking a cake and she's putting flour and sugar. That is in regular ounce. Okay, whereas troy ounce is a different matter. So when you look at it, it's a different kind of. So one is 6.85 pounds, one is 6.25 pounds. So precious metals are traded in units of troy ounces. So this statement also should not have been made. In a finance textbook, we can't have people writing these kind of statements. Contract size is 100 ounces. When you're discussing gold futures, it should be 100 troy ounces. So you should understand this. When you read gold, if you open the gold futures contract, you will see that the contract thing is. So you can read about this and find out the details. You don't have to remember this. You can set it up in your spreadsheet. But the point to understand is that there's a difference between troy ounce and ounce. So when you're talking about precious metals, okay, gold, silver, platinum, palladium, they trade in troy ounces. Okay, and the other thing to understand is that the international convention for trading gold is not what we do in India, 10 grams and all that. It is actually US dollars. The international gold market operates in terms of US dollars and cents per troy ounce. So the market in the US dollars is troy ounces. This is a unit of trading, okay, troy ounce. And of course, the underlying market is gold. Okay, so you have the market here is gold. The two assets in this market are gold and US dollars. The market instrument combination is gold US dollar futures. Okay, or we just call it gold futures, traded in US dollars. This is a price quotation system, dollars and cents per. And this is the unit of measurement. Okay, so when you're looking at any market, you should understand a few things, which is what are the two assets? Gold and US dollars. Any market you look at, notice these things, gold and US dollars. What is the unit? Okay, base asset unit. Base asset is gold. Base asset unit is troy ounce. It's not 10 grams, it's troy ounce in the international markets. Okay, notice that. Notice the contract size in case it's an exchange traded market. Notice the contract size 100 troy ounces. Okay, and then also notice whether it's an exchange traded market or a OTC market. All right, so what he should have said here is it should have been made as, the statement should have been troy ounces. You can't have this written in a finance textbook that gold futures is in ounces. Okay, it is in troy ounces. So the distinction between these two. Okay, these are two comments I wanted to make, and that's basically it. So I would suggest you guys read this daily settlement of losses, gains and losses. Read this so you understand. That will help you to understand how this is happening. How is the exchange clearinghouse? Because the exchange clearinghouse has an obligation to Vipul and it has a separate obligation to Utsav. Now, if Utsav defaults, the semi-clearing can't tell Vipul, I'm sorry, Utsav has defaulted, so I can't pay you either. No, it's an independent obligation to Vipul, so it will manage the risk of both of these people by taking daily deposits. Okay, so if Vipul loses $2,000 on the first day, they will force him to pay $2,000 the next day into their account. Okay, if it has hit the variation margin account, if it has hit the maintenance margin account. Okay. So I'll just wrap it up here very quickly. So that's how it's going to happen. So every day's gains and losses are going to be settled, not the futures contract itself, but the gains and losses on the futures contract will be settled by forcing the loser to pay to the deposit into the CME clearing account through the broker clearing member, and they will allow. So Vipul loses $2,000, Utsav is gaining $2,000, and so Utsav can take that money out. Vipul has to pay actual money, assuming it's at the maintenance margin level. He has to pay variation margin. And then Utsav can take that money out of his account and go and have a nice meal or whatever. And that's how it's going to work. Okay, so figure this out, read this from the book, how it's actually done. And then we can proceed further from the next day onwards. All right, okay, so the class is dismissed. I've taken only 1 minute extra. So the class is dismissed, and anybody has a conceptual question can stay back, and the rest of you can leave.
Sir, if you can ask others if they are able to access the files.
Okay, 1 minute. So guys, those who are still left here, Gaurav is having a problem. Gaurav is saying that he's not able to access this notes file. Although interestingly on my, look at my, so 1 minute, Gaurav, this is an administrative question. Before I handle this question, I'll close the video. Does anybody have
Sir, I have a doubt.
You have a conceptual doubt, right? So Gaurav, just hang on.
Yes, sir.
Conceptual question, and I'll close the recording, and then we'll come to. So we can see Kanika has joined. Kanika has actually opened the spreadsheet, so she's able to open the spreadsheet. Now let's.
Sir, even I am able to access the notes.
So Mithali is able to access. So there's some kind of problem having. We'll come to that. Let's deal with Mithali's conceptual question first. What is it?
Yes, sir. Sir, like in the copper trading, we have deliverable.
Yeah.
So, if I am short selling, if I am selling first, then how the deliverable thing going to work?
Yeah. So in this case, what happens is that you have to, as a seller, you have two options. Okay. You have deliverable in the sense that it's a good question. It deals with how exactly it works for a short seller, person who's going short. So if you have a short position in copper, you can settle it in two ways. This doesn't mean that you're forced to do it this way. Very good question, actually, because it clarifies the meaning of this statement. It doesn't mean that you're forced to do delivery by physical delivery. You can also close out your position. So you can look at.
Your voice is breaking.
Okay, can you hear me now? If we look at this, if we go back to
yes, sir. Yes,
yeah.
Sir.
So if you're short copper futures, you have two options to discharge your obligations under the contract. You can either deliver physical copper. So if you were short, let's say May 2021, okay, you're short for May 2021. You can either make arrangements that May 2021, when it comes to the expiration of the contract, which is, as we noted, I think it was like three business days before third last business day of May 2021. That'll be the final day of trading, and then there'll be certain delivery dates as well, with first notice, first notice, last notice, etc. We'll come to that later. But the point is that in May 2021, you have to broadly speaking, you have to deliver the contract. You need to finally settle the contract in May 2021. So you have two options. You can either physically deliver copper of this amount, whatever number of contracts you're short, times 25,000 pounds. You can deliver physical copper into the warehouse. Remember, we saw those. If you go to the contract specs, I don't want to keep reloading those pages again. But if you go to contract specs, if you remember, there are certain conditions on warehouses and the grade. So you need to make sure you have copper of that grade, and it has to be delivered to this is traded in the NYMEX division. It's in New York. So there'll be a New York warehouse where you will have to deliver. There'll be some designated warehouses where you'll have to deliver that physical grade of copper. So you can either do that, or you can actually just look at it and say, okay, let's assume that when it comes to May 2021, the price is the same, 352, and maybe you're short at 4.05 or something. So what you can do is whenever you want, you can actually close out the contract. So you're short at 405, you can buy it back at 352, and then you're home and dry. Then you don't have to worry about, you've already settled your contractual obligation because you have squared your position. You don't have a position anymore. So you've, right? So that's another way. So the option to, so it's a good question because it highlights that the option to close out your position is always there, even in a contract where the physical method allows, the settlement method allows for physical delivery, right? So that's an option that's given,
Yes,
to you, but you're not forced to do that only. All right?
Yes, sir. And sir, one more thing, like in the last two classes, when we were studying about the long underlying options.
Yeah.
So we are taking it as an assumption that we are going long underlying, that we are buying call and selling put. If we will do vice versa, then the situation will be different. Is it like that?
Yeah. Because remember, long underlying, we were only discussing, those were the discussions related to arbitrage free valuation and how you arrive at, how you use the technique of arbitrage free valuation to arrive at a fair value for a particular type of market instrument combination. So that long call short put is equivalent to a synthetic long underlying, right?
Yes, sir. Yes, sir.
So if you are discussing now synthetic short underlying, then you won't do long call short put. No, what would you do then? What is a synthetic short underlying? How?
That was like in synthetic short underlying, we will be selling call and buying put.
Correct, right? So if you are now discussing the particular market instrument combination and the market instrument position that you are discussing, earlier we had done our discussion with respect to long underlying, and then we had talked about, okay, what is the synthetic equivalent of the long underlying? Now if I change that and start talking about short underlying, then the synthetic equivalent of the short underlying will not be long call short put, but short call long put.
Yes, sir. Yes, sir.
So does that clarify your question a little bit?
Yes, sir.
Yeah. So all those discussions are happening because the way you do arbitrage free valuation, the way you apply that technique is for any particular thing. Like even if you're discussing copper futures, okay, in this case there may not be a AFP fair value, okay, a true AFP fair value, but the way you would do it is that you would look at this market and say, okay, copper futures, is there any way for any maturity, let's say May 2021, is there any way for me to create a synthetic equivalent of this market instrument position, long copper futures, okay? Can I create a synthetic equivalent of this? Okay, in this case, there will be, because that will be again through options. Okay, so there are futures options on this. Remember, if you go here you see, you can see that options are listed on these contracts. So this is just like the same logic we had May 2021. Okay, you look at the options. If you want to go long underlying, if you want to go long futures, you can either go long futures directly, or you can go long futures by buying the call, the May 2021 call, and selling the May 2021 put. That would be the synthetic long futures. You get my point?
Yes, sir. Yes,
So,
sir.
arbitrage free valuation, when you're applying that technique, you look at anything and say, okay, I can either directly trade in this market. That's one option, one alternative open to me. Or I can look around and see, is there any way to create a synthetic long position that means not the direct position, but a synthetic long position or short position in this market using other market instrument combinations. Okay, and the answer to that question is here in this case, yes, you can buy the call and sell the put and create a synthetic long underlying position. And then we say, okay, then the cost of these two should be the same because the outcome is the same. Got what I'm saying? So like it's a identical, it's like saying that, you have two identical flats, one bedroom studio apartments on the same floor with the same view in the same apartment, in the same apartment complex. Then they should have the same rent. If they're both unfurnished, then they should have the same rent. Are you getting what I'm saying?
Yes, sir.
Yeah, so that's the logic. And if they're not the same rent, then you buy one apartment and you sell the other. The one with the lower rent, you take it. You buy the one with the lower rent and sell the one with the higher rent. And
Yes, sir. Yes, sir. Got it.
the profit. Yeah. Okay, so that clarifies your question. Okay. Now, any other conceptual question?
Yes.
Okay, so we can now go back to Gaurav's technical question.
Sir, I'm facing the same problem as Gaurav.
Who is this?
Sambhavna.
Okay.
So, Kanika, this side, we are able to access the notes master, but the Word documents are not accessible to us.
1 minute.
Yes, sir.
Okay, some of those, now let me first understand before I get to the other people. Let me first understand Gaurav's problem. When Gaurav is saying, now look at this. See, I am showing here, Kanika is here. This is, who am I showing here? It's not showing, but I'm presuming this is Sambhavna and this is Gaurav. For some reason, it's not highlighting right now. But so when Gaurav is being shown as a person accessing. So Gaurav, when you say I'm not able to access, are you saying you can't even open the spreadsheet?
No, sir, I'm able to open the spreadsheet, but I'm not able to open the links in the column D.
Okay, 1 minute. Okay, so now that's a different statement. See, now so Sambhavna has worded it better. So you should have that is what you should have said. You should have said that you can open the spreadsheet, because when I look at the log, I can see that you guys have opened it. Okay, so I'll have a look at this. I'm sorry about that. I should have checked it, because I keep moving these things. When I want to do CP for you guys, I want to move your access, and then maybe I forget to make sure you can access it once again. So let me make these accessible to you. Okay, I'll just make sure that all these notes are back in your folder. So what you guys are saying is, what Sambhavna is saying also is that, like, if you click on this, you can't open it. Is that what you're saying? Right?
Yes, sir.
Okay. I'll make sure that this is taken care of. Just give me a little time. Okay, maybe by end of today I'll finish everything. It may take a little bit of time. I'll try and do it right now itself. Okay, but I'll make sure all these documents that are referred to are of this entire set of notes is back in your folder. Then you can access it. Okay, I'll take care of that. Okay, and then after that, so Gaurav, you have to remember one training for you from this incident is you have to be more specific about what you're saying. Okay, you should have said that, because the impression I got from your statement was that you're not able to open the file, it's the spreadsheet itself. So this is a more specific statement which Sambhavna has made, which is correct. Okay, all right.
Okay, sir.
Okay, all right. So let me just give me some time. I'll do that. Any other problems, guys?
No, sir.
Okay, all right. Okay, thank you.